I like to always think that there's a deal to be had in most markets. However, there's a lot of bad deals to be had as well. If you buy a stock at a bad valuation, you could be risking muted returns or even worse, negative returns over the near term. Buying a stock blindly without understanding valuation can be a losing strategy for your portfolio. And in today's video, I'm going to take a look at 3 dividend-paying stocks that I believe are overvalued. That doesn't mean I never want to own these particular stocks, as a few of them are fantastic companies. But at today's valuation, they don't warrant a buy into my portfolio. So before we begin, do me a huge favor and show your appreciation by clicking that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is Neos Investments. Neos Investments offers a suite of option-based ETFs that seek high monthly income and tax efficiency across core portfolio exposures. The firm's founders are pioneers in the option-based ETF space, an area that has been growing rapidly, having previously created and managed some of the largest option-based ETFs currently in the market. Neos ETFs may be of particular interest for many of my viewers that are looking to generate passive monthly income inside of their investment portfolios. Their ETFs offer exposure to major U.S. indices such as the S&P 500 or the NASDAQ 100 index, with that primary objective I just mentioned of pursuing tax-efficient monthly income for their investors. Between their 4 ETFs you can see here, the Neos team has ETFs that may offer enhanced income across both the equity and fixed income sleeves of your portfolio. Be sure to check them out at neosfunds.com. Investors should carefully consider the investment objectives, risks, charges, and expenses of exchange-traded funds before investing. All right, let's jump back into today's video, taking a look at 3 overvalued dividend-paying stocks. And remember, the name of the game is to buy low and sell high. We don't necessarily want to buy high because then we might have to sell low. That's a losing proposition. So let's begin with our first overvalued dividend stock, which is Costco Wholesale, stock ticker COST. I love Costco. I love shopping at Costco. The stock has been fantastic. I could get lost at a Costco Wholesale, but that's besides the point. We need to be able as investors to separate the company from the stock price. And right now, the stock price just looks way too rich. Probably the most overvalued stock on our list today. Taking a look here, you can see the company has a market cap of $325 billion. And over the past 12 months, the stock has been rolling up 54%. And year to date, it is up 11%. Being in the food business or the grocery business is typically a low margin business. And over the past 12 months, just looking at gross margins, Costco has been able to generate about a 12% gross margin. That is before getting into any of the operating expenses it takes just to operate the business. That margin is propped up slightly though by membership revenues, which, as you can imagine, is a very high margin sale. And before we jump into company results, let's take a quick look at the dividend. Costco is not really known as being a big dividend payer, but they do drop that special dividend quite regularly. Right now, they yield a dividend of less than 1%, but they do pack some serious punch when it comes to dividend growth, as the company has a 5-year dividend growth rate of 12.3%, and they have increased their dividend for roughly 20 consecutive years and counting. Again, this is a fantastic company, well run, just overvalued. Let's take a closer look at company results. Over the past 12 months, revenues are up 6.2% to $248.8 billion. Operating income during that time span is up 10.4% to $8.9 billion. So they're finding ways to be more efficient, which is great. Operating income margin over that time period is at 3.6%, up about 20 basis points over the same period a year ago. Turning to the cash flow statement, we could see the company generates free cash flow of $6.2 billion, and they have a low free cash flow margin of just 2.5%. So as you can see, when all is said and done, the margins are so very tight. Looking out over the next 3 years, revenues are expected to grow around 6% per year on average, not a particularly fast-growing company, which the PE multiple would have you thinking otherwise. EPS growth over the next 3 years has an average growth rate of about 10% per year. So with that, let's take a look at valuation. 2024 EPS is expected to come in at $16.02 per share, giving the company a forward PE multiple of 45.7 times. If we want to go even further out to August of 2025, that still gives the company a PE multiple of 42.4 times. Over the past 5 years, Costco has traded closer to 38 times. The stock already normally trades at a very high premium, and you're not packing a ton of growth when it comes to that premium. But right now, in the mid to low 40s, we are talking NVIDIA multiples, and NVIDIA packs some serious growth potential moving forward. Not the case when it comes to Costco. I think Costco has gone way too high where it is right now, and I'm going to just wait for that to pull back. And that leads us to overvalued dividend stock number 2, which is Procter and Gamble, stock ticker PG. Again, Procter and Gamble, a fantastic company, very well run, with a suite of portfolio products that we use on a regular basis inside pretty much every household. However, again, got to separate the company from the stock. Right now, Procter and Gamble trades at a market cap of $383 billion. Over the past 12 months, stock is up 11%, which happens to be the year-to-date gain as well. So for starters, Procter and Gamble has had a strong credit rating of AA-. However, when we look at the balance sheet right now, things don't look all that great. Right now, the company has a current ratio of just 0.64 with a quick ratio of 0.4. We would essentially like to see both of those metrics above 1, which would indicate a solid balance sheet. Unlike what we saw with Costco, Procter & Gamble is able to generate a decent yield when it comes to both operating margin as well as free cash flow. But before we get into that, let's take a quick look at the dividend. As you can see here, the company pays a dividend yield of 2.3%. They have much lower dividend growth with a 5-year dividend growth rate of below 6%, and they are a dividend king as they have 67 consecutive years of dividend growth. Again, a sound company, great products. However, valuation just looks stretched. Let me show you what I'm talking about. Over the past 12 months, revenues are up 4.5% to $83.9 billion. Operating income during that time span is up 14.3% to $20.9 billion. So some solid improvements over the past 12 months. In terms of margin, the company generated operating margin of 24.9%, up 200 basis points from the same period a year ago. Turning to the cash flow, we could see the company generated free cash flow of about $16 billion, giving them a free cash flow margin of 19.1%. So much better margins than Costco, but margins have been decreasing over the past few quarters. Definitely something to keep an eye on. Looking out over the next 3 years, revenues are expected to grow only about 3.5% on average, as they are a very mature business. EPS growth over the next 3 years has an average growth rate of about 8%. So with that gives us valuation with 2024 EPS expected to come in at $6.44 per share, giving us forward PE multiple of 25.2 times. The company typically trades at a 5-year average of 23 times. Procter & Gamble, again, great company, a ton of great products. However, slowing growth, decreasing margins for 2 consecutive quarters, and now we're looking at paying a premium just doesn't make sense, especially looking at a balance sheet that does need some work. So definitely, I'm taking a pass when it comes to Procter & Gamble. And that leads us to overvalued dividend stock number 3, which is Dick's Sporting Goods, stock ticker DKS. Like Costco, although I don't frequent Dick's Sporting Goods as often as I do Costco, I really enjoy going to Dick's Sporting Goods. Taking my kids, they're big into sports. Seems like we're going there all the time because they're outgrowing their cleats or outgrowing their soccer shoes, whatever it may be, on a regular basis. And Dick's Sporting Goods is the premier sporting goods store here in the U.S. The company currently has a market cap of $18 billion, and over the past 12 months, the stock is up a staggering 64%. But much of that has come in the current year here in 2024, with the stock up 53%. What has been going on with the stock, you might ask? Well, the company recently reported their Q4 earnings, which beat analyst expectations on both revenues and EPS. Oh, and then they issued guidance. That beat analyst expectations as well. Oh, and one more thing, they announced a 10% dividend hike. Speaking of that dividend, the company currently yields a dividend of 2% with a 5-year dividend growth rate, that's not a typo, of 34%. The company has increased their dividend for 9 consecutive years. Let's take a closer look at company results. The balance sheet is quite stable at the moment, with a current ratio of 1.8 and a quick ratio of 0.7, so pretty decent there on the balance sheet. Now taking a closer look at the income statement and statement of cash flows, where we see revenues of $13 billion, a 5% increase from prior year. Operating income came in at $1.4 billion, which was an 8% decline from prior year. Operating margin stood at 10.5%, down 150 basis points from the same period a year ago. Free cash flow generated for the year, $1 billion, giving the company a free cash flow margin of 7.2%. So another low margin business, not as low as something like Costco, but still a low margin business overall, especially with all of those online retailers. There's so much that Dick's Sporting Goods sells that things like Amazon, you can get there as well. So definitely a lot of competition within this space. Let's take a look at the next 3 years in terms of projections for revenues and EPS, beginning with revenues, where the company is expected to grow only about 3.5% its top line per year on average, so very muted growth expected ahead. In terms of EPS, over the next 3 years, the average growth rate is about 6% per year. So with that, let's take a look at valuation, where 2024 EPS is expected to be $13.19 per share, which equates to a forward PE multiple of 17 times. Over the past 5 years, DKS shares have traded at just 12 times. So again, a really tough environment. The stock has been taken off a ton. Solid results overall, an improvement. They went through a ton of inventory issues during the pandemic, and they're climbing out of that pandemic hole. But I just feel that the stock has ran way too far. Muted growth, very high multiple, especially compared to its 5-year history. So with that being said, we just covered 3 overvalued dividend stocks, in my opinion. We had Costco, Procter and Gamble, and Dick's Sporting Goods. All 3 of these companies and their stocks have done quite well to start the year here in 2024, and they've done relatively well over the past 12 months also. Down in the comments section below, though, let me know which of these 3 do you agree with, and which of these 3 do you believe is actually a buy at current levels. And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.